Okay, let's dive into this. Welcome to This Explainer. Today, we're taking on a massive core mission, demystifying the absolute hardest financial milestone you're ever going to face in your entire life. Look, if you've ever felt like saving money is just this impossible uphill battle where you're putting in maximum effort for basically minimum reward, I promise you're not alone. Today, we're going to break down exactly why that happens and, more importantly, how you can conquer it using the combined wisdom of some truly legendary investors. The late, great Charlie Munger really didn't sugarcoat this at all. Whether you translate his famous rule to your first 1 lakh or your first 10 lakhs, the reality is exactly the same. It's hellish. But as he bluntly put it, you just gotta do it. This actually aligns perfectly with what Napoleon Hill called the test of your definite chief aim. Reaching this very first milestone isn't just some boring math problem, it's actually a profound psychological test of your burning desire to build real wealth. I want you to think of your wealth creation journey exactly like a rocket launch, right? To escape Earth's gravity, a rocket has to burn its absolute maximum amount of fuel in just the first few kilometers. Well, building your first 1 lakh is your financial gravity. It demands your absolute maximum mental and financial sacrifice right up front just to break free from zero. You are literally burning through your willpower to establish that initial momentum. All right, so that brings us to phase 1, the gravity of zero. Let's talk about the brutal reality of starting with absolutely nothing. Here's where the friction of those early days really kicks in. In step 1, the launchpad phase, your active income dictates everything. You're sweating and grinding to save that very first 5,000 rupees, and what do you actually get for it? Maybe a tiny 50 rupees in interest. It feels completely insignificant, doesn't it? And this right here is exactly where 90% of people just give up. They get used to failing. But you've got to push through to step 2, because when you hit that 1 lakh mark and finally reach orbit, the physics of your money fundamentally change. Your money actually starts creating its own little army to fight for you. And here is exactly why that army matters. 12 to 15%. This is the historical average return of something like the Nifty 50 index fund. Once you hit that 1 lakh and invest it there, your money is generating 12,000 to 15,000 rupees a year all on its own. You don't have to sweat for that money anymore. The money has started doing the heavy lifting for you. The engine's on, and the train is finally starting to move on its own power. But to get to that beautiful point, we have to navigate the biggest threat to the mission, phase 2, the opportunity cost trap. Opportunity cost completely reframes our daily decisions. It is essentially the hidden price of looking rich. When you give in to that inner consumer and go buy a 50,000 rupee phone on EMI, you aren't just handing over 50 grand. You're actively sacrificing the massive wealth, the absolute freedom that this money could have generated for you over the next 10 years through compounding. Saying yes to a short-term thrill means saying no to lifelong freedom. Let's look at this classic showdown. Think about 2 totally different paths. First, the wrong path. A young professional gets a raise and immediately buys a massive car on EMI. Their cash flow instantly stops and they become completely mentally enslaved to debt, exactly as Napoleon Hill would warn. Now think about Munger's path, the smart investor. They keep driving their trusty old scooter. They take that EMI money and quietly run SIPs into quality stocks like HDFC or Infosys. 5 years later, the consumer is still crushed by car payments, while the investor has absolutely smashed past that 1 lakh milestone. Self-discipline over emotions is the only way to win this game. And look, we know this is incredibly hard, especially given society's pressure test. There is this massive social pressure to spend recklessly on big weddings, festivals, and the newest gadgets just to look wealthy to your friends. But remember this. Buying a share of Maruti Suzuki is a far, far smarter move early in your journey than actually buying their car. You have to ignore the crowd. Be a little crazy. While everyone else is blowing money at weekend parties, you're quietly building an empire brick by brick. Now, to actually survive this journey, you need a navigation system. Welcome to phase 3, your circle of competence. After all, you can't fly a rocket blind. Charlie Munger popularized this incredible mental model. Your circle of competence isn't about knowing everything in the world. It's about knowing exactly what you understand, and crucially, violently avoiding the things you know absolutely nothing about. Napoleon Hill warned us that ignorance, basically denying what you don't know, is completely fatal. Flying blind outside your circle is just the quickest way to crash your portfolio and wipe out years of hard-earned savings. To expand that circle, you've got to become what Munger called a learning machine. Read constantly so you can spot opportunities where everyone else just sees dark clouds. And please ignore those hot stock tips. If you know absolutely nothing about the pharma sector, investing based on a tip is just gambling. Stick to what you know. If you're a software engineer, you actually understand the business models of TCS or Infosys. Leverage that unfair advantage. By connecting models from psychology, history, and math, your greatest asset isn't your bank balance, it's your expanding intellect. Okay, now we reach arguably the hardest phase of the journey. You're in orbit. So, what do? Welcome to the magic of inactivity. So, the crucial point is captured perfectly in Munger's famous secret: sitting on your ass. Now, do not mistake this for laziness. This is actually the ultimate test of patience. Your brain is going to scream at you to check your portfolio, to tinker, to make a trade, but overtrading ruins your profits. The market is basically just a device that transfers money from the impatient to the disciplined. The real, big money is always made in the waiting. If we look at the timeline of compounding, it really proves the sheer power of waiting. Year 1 is agonizingly flat and boring. Your friends are buying cars, you're still on that scooter. But hold on to year 5. That's the tipping point. You cross the 1 lakh mark. Then uninterrupted compounding takes over. By year 10, the magic really happens. Your portfolio surges, potentially hitting 25 lakhs as the market booms without you having to put in a drop of extra sweat. It starts flat, but then it just shoots straight up. But you have to survive that flat line. Napoleon Hill told this amazing famous story of the miner who was 3 feet from gold. The guy dug and dug, found nothing, and finally just quit in utter frustration. Another miner came in, dug just 3 more feet, and struck a massive vein of gold. That is the exact tragedy that happens when you hit 70 or 80,000 rupees. You get tired, you want to withdraw it all just to buy something fun. Please don't quit 3 feet from your breakthrough. So how do you actually survive that wait? Never interrupt compounding unnecessarily. You must become like a deeply rooted tree during a crazy storm. Ignore the market volatility. Rely on history. Every crash is inevitably followed by a boom. Trust the decades of stability built by absolute giants like Titan, L&T, and Kodak Mahindra. When the market dips, an educated investor doesn't panic. They see strong companies like Asian Paints or Pidilites on a massive discount sale, and they take action. Finally, let's step into the highest level concept of long-term wealth. Phase 4, the final frontier, wealth built on trust. Reaching that first 1 lakh is not just a test of your math skills. It is a test of your character. The golden rule states that wealth built on deceit or taking advantage of people is just a house of cards waiting to collapse. True, lasting wealth, the kind that actually stays in your family for generations, requires incredibly high ethical standards. Honesty is quite literally the foundation of your empire. Understanding the value of your reputation is absolutely vital. Munger considered reputation to be the ultimate asset. Think about it. Building trust takes an entire lifetime. You're weaving this seamless web of reliability just by helping others and solving their problems. But on the flip side, it takes just 5 minutes of poor ethics, a single greedy decision to completely destroy a lifetime of hard work. And when you're looking for where to park your money, look for this standard in others. The Tata Group is a prime Indian example of this exact philosophy. When you invest in companies with this kind of pedigree, you aren't just buying a business model. You're betting on their integrity. You're betting that they are creating real, tangible value for society. Because adding value to society naturally, inevitably, attracts more wealth. Let's lock in the mental software you need to conquer this financial gravity once and for all. Here is your launch checklist. Number 1, kill that inner consumer and conquer instant gratification. Number 2, build your circle of competence. Know what you know and ignore all the noise. Number 3, master the absolute magic of inactivity. Let compounding do the heavy lifting while you sit patiently. And number 4, operate with unbreakable ethics because trust is what keeps the wealth in your hands for good. So, I want to leave you with this final, really provocative thoughts. You know the gravity is intense, but you also have the complete blueprint to escape it now. So what is your definite chief aim? What is your exact deadline for hitting that first 1 lakh? Are you going to commit to doing it in 1 year, 3 years? Step into your new identity as an investor today. Set your timeline and start building your empire. Thanks for joining me on this explainer, and I'll catch you on the next one.